Well, Robinhood is just the latest fintech company to file for an IPO. The company isn't expected to come to market until later in the second quarter, but it's joining a long list of fintech companies that are tapping into the public markets. Yahoo Finance's Dan Howley is on that story for us today. And Dan, Robinhood, of course, really in the news because of what has played out with some of the meme stocks, but there are many other online trading platforms, fintech companies that really see an opportunity, especially during this time in the public markets.
Yeah, that's right. We talked to Renaissance Capital's Kathleen Smith, and she gave us kind of a rundown of the different companies that are coming to market or expected to come to market in 2021 that are in the fintech field. So I want to start off with kind of Coinbase as basically one of the larger ones, and they're obviously going to be a kind of fintech play that allows you to get in, crypto play that allows you to get into the crypto market without having to deal with the volatile swings that can follow when you invest directly into a crypto asset such as Bitcoin or Ether or Litecoin, something along those lines. So it really is an exchange, and it will enable you to be part of that, get the boost from that without having to deal with the ups and downs. And then one of the others that I actually found really interesting is Better.com. That's a lender for online mortgages. And it's similar to what you might see as a Rocket. They obviously IPO'd last year in August. They raised $1.8 billion for a valuation of $36 billion. And they're expected to come to market this year. They have a valuation of $4 billion. And really the big thing about them is they're not going to charge you or hit you over the head with fees. They're available 24/7. And they're going to be able to provide you loan estimates right away. So it's going to be a little bit easier than what you might get out of brick and mortar. But there are some loans that they're not working with right this moment. And then another one that I just want to quickly highlight is Blockfi. This is a financial services lender that allows you to put up your cryptocurrencies as collateral for loans. So this way you can have them kind of held there and get actually US dollars out of that. But they also have a savings account that provides you 8.6% interest on your crypto assets. So there really are a number of different plays out there for fintech. If you're not generally interested in Robinhood and you want something that hasn't been part of the big meme stock craze, as Akiko, you pointed out. So there are a number still out there.
Okay, Dan, stay right there. Let's bring in Kathleen Smith, a Renaissance IPO ETF manager. Kathleen, Dan just pointing to the discussion he had with you about just how much activity we've seen among the fintech space, but we've seen IPOs overall continuing at a blistering pace here. 102 companies coming to market so far, raising more than $40 billion. That marks the busiest quarter in 20 years. Is there a sign that maybe a lot of that enthusiasm is coming to an end? How do you look at the numbers that we've gotten in the first quarter alone?
Right. We are seeing record numbers for this first quarter. It's down in the history books in terms of the dollars raised. And also, if you add SPACs, there's been nothing like it. And the SPAC market has raised twice the dollars that the IPO market has raised. And also, we're seeing this quarter, we saw more billion-dollar IPOs than we've seen in history. So this one is for the record books. But we are finishing up this quarter with a little less momentum. And it kind of reminds me of the month of March, which kind of comes in like a lion, this is the quarter, and out like a lamb. And so we are seeing some signs that this heavy activity is going to slow down. And I would point to our Ipo Index. That is a basket of the largest recently public companies, which had a very strong performance in 2020, up 100+%. But so far this year, the performance is negative, down about 6%. And the performance is tied to the activity in the IPO market. So when investors are not seeing that follow through, which you can measure by this index, then that's a sign that deals are going to they'll be harder to get done. They need to be priced more favorably, and maybe some won't get done.
On that front, there's a line that stood out to me in your report, Kathleen, that says after soaring an average of 32% on the first day, which was in line with the last 3 quarters, enthusiasm was down, with new issuers averaging a 14% loss from the first day close. So is that, to your point, an issue on pricing, or does that suggest that the enthusiasm, especially around these startup companies, are starting to wane overall?
Well, there's a little bit of both, because there's a lot of product in the marketplace, and the product IPOs have to fit in institutional and investors' portfolios. So there's a little bit, I think, weariness, but also pricing. We're at very high valuations for high growth companies. And when there are signs that interest rates are starting to rise, that's making investors nervous about and repricing the companies that are out there. And the IPO market has an awful lot of those very high growth, high valuation companies. So we have that that's happening in the market.
Kathleen, I want to ask, do you think it's the type of companies or the spaces that they're playing in, or do you think it really is, what you just mentioned as far as the trepidation that some investors may see?
Dan, it's a good point, because there is this shift from the at-home kind of companies, the Zooms, the Pelotons that made sense during the pandemic and the work from home period. Now investors are looking forward to the opening. So you can see eyes and better performance are on these companies. Like Frontier Airlines is on the calendar to go public. Well, I don't think that company could have gone public 6 months ago. And yet Frontier is coming out, and Sun Country is a similar airline that just recently tapped the IPO market successfully. So we're seeing some different kinds of companies come out. There's no doubt. There's a lot of worry that this is the internet bubble. And surely when it comes to the amount of dollars raised and the frenzy of activity, it's hard not to look back to that time. But I will point out that the companies that we've seen already, even the ones during the work from home and these upcoming ones, most of them are substantial businesses. They have revenue, they have earnings. I think the key challenge for investors in IPOs is what's the right price, because IPOs can be really volatile. And I do think there's some valuation discovery happening, particularly with the technology and healthcare companies that have gone public over the last year.
Kathleen, you alluded to the SPAC boom that we have seen, more SPAC deals in the first quarter than we saw of all of last year. Do you see this as a permanent fixture? Now, we had a guest on last week that said this is just another avenue that a lot of these startups now have to come to market, and yet that seems to counter with those who are much more skeptical of these blank check companies, saying this is just a sign of froth in the market. What did you find in your study?
Yes, there's certainly froth in the SPAC market, and the issue, and in fact, if you look at the average return so far, they're pretty close to flat, which makes sense because a new SPAC is just a pool of cash. Direct listings are a viable option, and we saw Roblox go public and have a very successful direct listing. The stock's up 50-some% from its first day. So there are different avenues of opportunity. When it comes to SPACs, the issue there is what happens after the SPAC announces a merger and actually explains all the details with filings and everything about what this new company is about, and the fact that investors have to absorb its valuation. What is it going to be worth? And it turns out that, while we've had some moonshots and some very good performance, DraftKings, for example, Virgin Galactic, there have been many that don't perform well. And so it's not one of those things that you can own a SPAC and not open up the book on it for a couple of years. You have to pay a lot of attention, because the companies on average underperform compared to regular way IPOs. They don't have the same vetting as a regular way IPO would. So you have to be very careful about holding through the acquisition. And I think right now the froth in SPACs has been, well, there's been money to be made by just owning the SPAC when it's a blind pool, and then selling and realizing a gain when there's an announcement, because there's a lot of hype around the announced acquisition. But once the acquisition's made, then the rubber meets the road. Companies have to do things and show what they can do to investors. So there's more risk in the SPAC market. Investors need to be aware of that. And you can see now the average SPAC, I think, is trading up 30% from its IPO price over the last year. The average IPO is trading better than that. And if you look at the number, for example, with IPOs, over half are trading above their IPO price, even now. With SPACs, you're way less than half, maybe 30% are trading above their IPO price. So you have to pay close attention to the SPAC market, which would be our advice.
Kathleen, what are you expecting for the rest of the year as far as interest in IPOs and IPOs in general? You know, we're kind of going to be in this weird space where it's still where we're not fully reopened. We're getting more people vaccinated. There will be reopenings, and then we may be fully reopened towards the end of the year. Do you think we're going to see a pickup in IPOs at that point, or do you think it's going to kind of depend on where the market is in general?
I certainly would focus on the Renaissance IPO Index to give you some indication about enthusiasm for IPOs. But there is a huge lineup of many incredible companies that are planning to tap the IPO market. So hopefully we'll be able to see some good valuations given we're in this period of a little more uncertainty. You mentioned Coinbase. I think that's one of the really exciting companies that investors are going to look at. It has a potential $50 billion valuation, and investors are looking at crypto and trying to figure out how to own stocks where they don't have to own the crypto, but can own a platform that might make money based on crypto trading. AppLovin, I'd point out, is another really interesting application marketing and monetization platform that's expected to do a $2 billion IPO. We've got Robinhood. We talked about Robinhood that is planning to tap the market despite all the controversy. And it could turn out that maybe the company will show us a more decent valuation, knowing that there's some uncertainty around Robinhood and what the regulation is going to look like. Some of the direct listings we're seeing, Instacart, it looks like the grocery delivery platform might try to go public in a direct listing. And you have to just watch what's going to happen with the SPAC acquisition of WeWork. WeWork, the company that 2 years ago just basically failed in its attempt to go public. It'll be so interesting to see how this SPAC manages to incorporate WeWork and what how investors view this acquisition once they see all the numbers. I mean, that was the issue with it when it went public. Everyone was so excited, but then we opened the prospectus and it was like, oh my gosh, it's really that bad. So hopefully this prospectus will look a lot better for Instacart. Sorry, a lot better
for WeWork.
Yeah.
Yeah. I mean, maybe that's an indication of where the market is. A company that couldn't come to market based on its S1 filing a few years ago, now coming to market through a SPAC. So it'll be interesting to see how they do there. Kathleen Smith, Renaissance IPO ETF manager. Great to talk to you. And our thanks to Yahoo Finance's Dan Howley as well.